You are welcome to my channel. This is Kevin Davis Accounting. Now, we are still continuing with our topic on the final accounts of a sole trader. Now, before we proceed to the question, I'd like us to talk about end-year adjustments. Now, end-year adjustments, these are adjustments that of course take place within the business, and they might not have been recorded into the trial balance. So remember, we have prepared the trial balance, and we find out that there are certain items that happened or occurred and were not recorded in the trial balance. Now, for example, we can have what they call prepaid expenses. So, prepaid expenses, let me give you an example that in our trial balance looks like this. Of course, we have the debit and we have the credit. Let me say there is rent, and rent being an expense, that means it will be here, and they tell you rent is 10,000. Now, when they say that rent is 10,000, yes, actually we paid rent. If you go back into our cash account, we paid rent worth 10,000 shillings. But then you find out in the additional information, they give you and they tell you that a half or 50% of that rent was for the forthcoming financial year. It is for the forthcoming financial year. So that means we are recording, or we want the transactions that took place in this financial year. Let me give you an example. When we were younger, our parents used to buy us shirts. For example, going for Christmas, parent gives you a shirt, and sometimes if this shirt was oversized, they take it to the tailor and they had to trim off the sizes that they were not wanted and remain with the size that were wanted. Now, the same knowledge is what we're going to apply here. That if we are looking at the financial year ending 31st December 2024, let me say for example, and they tell us that actually the amount of money, which is half of the rent here, was for the forthcoming financial year. That means we are supposed to come back and correct this in the statement of financial position and the income statement. So you find out that they give you additional information, and they tell you that a half of rent paid was for the forthcoming financial year. So it means actually we are supposed to correct this. So in our income statement, under the expenses, we shall go under expenses and say rent. You see, then we mention the amount, which is 10,000. But remember, it's true, this is the money that we paid for, but this was not the money that was actually incurred, because we are looking at how much was incurred. You see, remember, we are paying, and how much did we use? We are paying for that period we have used. So that means the 10,000 was actually the money we paid, but it was not the money we incurred. It was not the money that we utilized. So that means we shall come back here and say rent prepaid, and we subtract off the half, which is 5,000. So that means we shall take one amount of rent as 5,000. So our rent will be 5,000 because we are looking at this financial year, not the forthcoming financial year. So the 5,000 will be catered for in the forthcoming financial year. So this is how it's supposed to be done. That means when it gets now to this, to the additional information, remember, this additional information has not gone through a double entry. Has not gone through a double entry system. Remember, these items already, they've already gone through the trial balance, and that means they've gone through the double entry system. So when it comes to the items and in additional information, we are supposed to record them twice. It's because we record them twice because they have not gone through the double entry system. So it means when we record our rent prepaid, when we subtract it off from the rent, then this 5,000, of course, that we have subtracted off, we shall take it to the statement of financial position, and it will be a current asset. Why? Because I have not yet used this amount of money. I have not yet stayed in the room for that period. So it means anytime I can go to the landlord or landlady and I tell them, you know what, I want my money back, they can give me my money. Remember I told that when we talk about current assets, we are looking at the level of liquidity, how fast an item can be turned into money. So I can go back to the landlady and I tell them, you know what, give me back my 5,000. I'm not going to stay in this room for this period. So anything, when we talk about an expense prepaid, it means actually we are supposed to take the value into the balance sheet as well as a current asset. So we shall subtract it off here. That's how we treat it. Now, after that, we also have the opposite of prepaid is expenses outstanding. So let me put here as current asset in the statement of financial position. Remember, it is an expense in the income statement. Then also when it goes to the statement of financial position, it becomes a current asset. Now, when we get to expenses outstanding, it means maybe let me say we are going to purchase some items and we don't have actually a full amount to cover those items. So we shall keep in books and we shall be demanding that money. So it means they are still demanding us that money. Still, let me give you an example of rent still. They are still demanding us that money. That means we are supposed to pay it. Let me give you a clear example. Salaries and wages. For example, we are here and say salaries and wages. Salaries and wages. So let me say it's 10,000 still. Then in additional information, they tell you that 2,000 Ugandan shillings of salaries remained outstanding. So if this is the case, then how are we going to treat this? So remember, when it is a salary outstanding, it means they are still demanding you. So when you come to the income statement, you're going to say salaries and wages. Then you put this figure, 10,000. Then this time, you come and say salaries and wages outstanding, 2,000. This time we shall add it because you have to pay that too. It is an expense that you are supposed to pay. This amount of money is supposed to pay. That means we shall take the final figure as 12,000. So when it comes to the salaries or expenses outstanding, it means we shall be adding to the expense. Now, since this item still has not gone through the double entry system, now when it is outstanding or due, we take it to the statement of financial position as a current liability. Remember, a liability is something that takes money out of the business. Now, this one, the 2,000 here, we shall take it to the statement of financial position as a current liability. So we shall record it as a current liability in the statement of financial position. So basically, this is how we are going to be treating this. Therefore, when it comes to this, we shall say it's a current liability. Then, before I go further, allow me to talk about something here. When it comes to the word outstanding, there are other words that they can use to mean outstanding. They should not confuse you. They can say maybe it is an expense outstanding, it's an expense due, it is an expense owing. They can say owing, outstanding, due. So those terms should not confuse you. It all means the same thing. Just like when you say prepaid. Prepaid also means in advance. For example, if they pay you in advance, so it means you are prepaid. You get? So that's prepaid. Now, allow me to talk about something else. I'm done with expenses. Let me talk about the incomes. Incomes prepaid. Now, when you are paid before doing or delivering a service for what you're paid for, then that's a liability. So if it's incomes prepaid, of course we shall go to the statement of financial position under the incomes and subtract off these incomes prepaid. Why? Because actually they have paid us that amount of money, but this amount of money has not been worked for. So it means we shall go under the incomes and subtract it off. Now, when it's an income prepaid, it means it becomes a liability because you have not yet fulfilled. You have not yet fulfilled the obligation for you to receive that amount of money. So that means someone can tell you, I'm going to fire you today. You have not yet done this, so give me back my money. So it is a liability to you. So an income prepaid, it is a liability. You go to the income section and then do what? Subtract it off. Then we have what they call incomes outstanding. Now, incomes outstanding, it means you're demanding that amount of money. So if you're demanding that amount of money, then that amount of money has to come to you. They're supposed to pay you that money. So if they're supposed to pay that money, actually this is a current asset. So you go to that income and add that amount of money that is outstanding. So this is a current asset in the statement of financial position. So we are supposed to do a double entry by one, posting the income statement, and two, we would actually wrap up the double entry in the statement of financial position. So that's how we shall be treating this. Then allow me to talk about something we call provision for bad debts. Now, provision for bad debts, let me say, when we talk about provision for bad debts, this one is charged against the trade receivables. It's charged against the debtors. For example, a small amount is taken off from the debtors to cater for those who might not pay. For example, we say 20% of the trade debtors are expected to default. Therefore, a provision against bad debts is supposed to be made. Remember, we are not supposed to anticipate profits. We are supposed to actually expect losses. So if that's it, that means what we shall do, we shall make a provision against them. Now, listen attentively. When there is an increase in the provision for bad debts, that's an expense. When there's an increase in the provision for bad debts, that's an expense. But when there is a decrease in the provision for bad debts, that's an income. When there's a decrease. So, note that sometimes they might say there was an increase in provision for bad debts, or they might say there was a decrease in provision for bad debts. That treatment of that two is different. So when there's a decrease, we treat it as an income. When there is an increase, we treat it as an expense. Now, let me give you an example. These are scenarios that are likely to happen. For example, we shall have provision for bad debts. Provision for bad debts in the trial balance. And additional information has and says, for example, it says that, let me say, a provision for bad debts is made worth 2,000. Now, sorry about this. Provision for bad debts, let me say here, it was, provision for bad debts here, it was, let me say, 3,000. And our debtors, or our trade receivables in the trial balance were 10,000. So how are you going to treat this? Now, one, we shall take this figure in the income statement as an expense. We shall treat the provision for bad debts first in the income statement as an expense. Then after treating it as an expense, then we shall go to the statement of financial position under current assets. And we say, current assets, we say we have our debtors who are worth 10,000. Then we come and say less provision for bad debts. These ones will not pay bad debts. Then we shall have 2,000 plus the 3,000 in the trial balance. We are supposed to deduct it. That means we shall deduct 5,000. And we shall have 5,000 as our debtors remaining. Now, remember, this 2,000 is going in the income statement as an expense. But when it comes to the statement of financial position, we are supposed to add the provision for bad debts in the additional information plus the one in the trial balance. Remember, the reason why we treat this one once is because it has already gone through the double entry system. This one has not yet gone through the double entry system. That's why we're supposed to treat it twice. So the information, the additional information, must be treated twice because it has not gone through the double entry system. Now, so this one will be added to this, then you shall post it like this. In case they just give you without the one in the trial balance, you just bring this and subtract it off here and also treat it as an expense. So that's how you're supposed to treat it. If there's an increase, then a decrease that side, we go and subtract it and record it as an income the other side. Then, let me talk about, lastly, allow me to talk about depreciation. Depreciation. Now, what is depreciation? Of course, I will treat this as a topic on its own. But depreciation has kind of two methods. Of course, this is a loss of value in an item. So if it's a loss of value in an item, for example, an item X was bought for 5,000. You find that after 1 year, actually its value is 3,500. That means there was a value lost and that value was 1,500. That one becomes the depreciation. Now, they can tell you, for example, they say a motor vehicle. So its cost was, let me say, 1,000. You see? And then they tell you that depreciation, okay, let me just give you an example here. Let me give you an example. We shall have, this is our trial balance. We have a motor vehicle. So motor vehicle is an asset, so that means we shall have here 1,000. Then, we can also have accumulated depreciation, by the way. And let me say it is 200. You see? And then they tell you in additional information that I'm going to actually give you two examples how it's supposed to be done. And they tell you one is depreciate tangible non-current assets. You see? By, let me say 20%, one, I on cost, and two, straight line method. Sorry, straight line method is the same as cost, so reducing balance method. Now, they cannot set it like this, of course, but I'm just doing this for the understanding and the class setting. Now, when they tell you to do this, and this is the number that I've given you. So one, this is what you're going to do. On cost, depreciating on cost, we shall have 20 times the 1,000. You see? And therefore, we shall have 200. So this one is the depreciation on cost. Then, on reducing balance method, we shall have 20 over 100 times, remember, we already had an accumulated depreciation of 200. That means this one was for the previous year. What we do, you do 1,000 minus 200. So you have 20 over 100 times, of course, it will be 800. So you will get a total of 160. So, be careful about which language they are telling you. Is it on cost or reducing balance method? So if it is reducing balance method, you're supposed to first subtract off the accumulated depreciation. Then you have a new figure and you apply the 20% on the new figure. Now, when we go down to the balance sheet, also the statement of financial position, for example, if this is it now, we shall have in the accumulated depreciation column, we shall say it will be 200 plus 200. So we shall have 400. Remember, we had our cost. Our cost was 1,000. Therefore, our net book value will be 600. You see? That's how we shall treat it. Then, when it comes to reducing balance method, we shall have our cost. It was 1,000. Then, our accumulated depreciation will be this plus the 200, which will give us, this was 1,000. Plus the 200, of course, it will give us 360. Therefore, we shall have our balance 40. 640 as our balance. So this one will be our new book value. So this will be the figure that we shall have. So that's all about end year adjustments. I'm going to solve a number on this together, and it's going to run from income statement, statement of financial position, even having end year adjustments. Thank you so much for watching. This is Kevin Davis Accounting. Share to your friends, subscribe, like. Don't forget to hit on the bell button so that you can have updates whenever I upload videos. It's a goodbye for now.